Hidden catalyst about to send SanDisk, SNDK, to $3,250. Welcome back to Smart Stock Sam, the channel where precision forecasting meets real market execution. I want to start today's video with a recap of our last update's price forecast, and I feel pride to say that. We called it. Last week, right here on this channel, we told you, not guessed, not speculated, we told you that SanDisk was walking directly into a mechanical trap that would drag it down to the $1,930 to $1,950 range. And what happened? The stock hit an absolute low of $1,938 to the exact range. Then it ripped to all-time highs. Now, if that doesn't have you leaning forward in your chair, what we're about to break down today absolutely will, because hidden inside the very mechanics that just triggered that perfectly called pullback is a catalyst so powerful, so structurally loaded, that it could send SanDisk screaming toward $3,250. And today, we are going to show you exactly why, exactly how, and exactly what you need to watch for the week of June 22nd. So if you are serious about your portfolio and you want to understand not just what is happening, but why it is happening at the mechanical level, you are in exactly the right place. Let's get into it. To appreciate where this stock is going, you first have to understand the journey of how it got here. SanDisk spun off from Western Digital back in February of 2025. At the time, it was trading between $36 and $48 a share. $36. Let that land. Today, it is sitting near $2,184 per share. That is a run of over 4,000% in just over a year. And here is what makes that number even more remarkable. This was not a meme stock. It was not a hype cycle. It was not some speculative biotech lottery ticket. It was a storage hardware company that most people on Wall Street dismissed as a boring legacy technology play. Nobody was writing breathless headlines about it. Nobody was posting rocket emojis. So how does a company that the market completely overlooked generate a 4,000% return? The answer is a single, unstoppable, tectonic shift that is still only in its early innings, and it is called the artificial intelligence supercycle. Now, when most people hear artificial intelligence, they think of chatbots and image generators. That is the consumer-facing tip of an enormous iceberg. Underneath the surface, the real artificial intelligence revolution is happening inside massive hyperscaler data centers, the infrastructure being built by the largest technology companies on the planet to train and run the models that power everything you see. And those data centers are absolutely starved for one thing: high-capacity NAND flash storage and enterprise-grade solid-state drives, the computational workloads required to train a frontier artificial intelligence model generate data at a scale that is almost incomprehensible. You need storage that is fast, reliable, dense, and available in enormous quantities. And right now, the supply of that kind of enterprise-grade storage cannot keep pace with the demand. That is the macro environment SanDisk is operating inside. But here is the critical insight. SanDisk is not just a passive beneficiary of this trend. They have actively repositioned themselves to become an indispensable utility inside the artificial intelligence infrastructure stack. Let me show you exactly what that means. Historically, memory chip companies were some of the worst long-term investments you could make. The reason is simple. It was a pure commodity business. When supply was plentiful, prices collapsed, margins cratered, and the stock got obliterated. When supply was tight, prices spiked, but it never lasted. The boom-bust cycle was brutal, relentless, and completely out of management's control. SanDisk has fundamentally broken out of that cycle. They have executed one of the most impressive business model pivots in recent semiconductor history. Instead of selling chips on the open spot market at the mercy of volatile pricing, they have locked in $42 billion in guaranteed minimum contractual revenue through multi-year prepayment agreements with hyperscaler clients. Read that number again, $42 billion, locked in, guaranteed. These are legally binding commitments from the largest technology companies in the world, and they represent a floor of certainty that almost no hardware company in history has ever been able to construct. This is not a cyclical commodity business anymore. This is a recurring revenue infrastructure model, and the market is only beginning to reprice it accordingly. And when you apply that business model transformation to their actual financial results, the numbers become almost difficult to believe. In the third quarter of fiscal year 26, SanDisk reported $5.95 billion in total revenue. That represents a 251% increase year over year. But even that headline number understates what is happening inside the business. Their data center segment, the division directly exposed to the artificial intelligence infrastructure build-out, did not grow by 50%, did not grow by 100%, did not even grow by 200%. It grew by 645%. And because they have transitioned to this contracted utility model, their gross margin has expanded from a historical range of around 26% all the way up to an elite 78.4%. For context, that is higher than many software companies. That is the kind of margin profile that belongs on a recurring revenue platform, not a hardware manufacturer. Nearly every new dollar flowing in from those artificial intelligence data center contracts is dropping almost entirely to the bottom line. This is not just a revenue story, it is a profitability masterclass happening in real time. Now, a company printing cash at this rate immediately attracts both investors and competitors. So how is SanDisk protecting this position? By aggressively fortifying their moat on multiple fronts simultaneously. They have secured 5 separate multi-year hyperscaler supply partnerships, meaning the biggest technology companies in the world are not just customers, they are contractually obligated buyers to ensure they have the raw materials and manufacturing capacity to actually fulfill those $42 billion in commitments. They extended their critically important joint venture with Kioxia through 2034, and they injected $1 billion of direct capital into Nanya Technology to expand upstream supply capacity. Think about what that means strategically. They are not just selling shovels in the gold rush. They have locked up the mines, the distribution channels, and the customers all at once. Can you name another hardware company that has simultaneously secured the demand side, the supply side, and the manufacturing relationships with this level of structural conviction? Because we are struggling to find one. Now, let's talk about what actually triggered the explosive move we saw on June 18th. Because it was not one catalyst. It was 4 separate catalysts colliding simultaneously in a perfect storm of bullish pressure. First, Apple's chief executive Tim Cook issued a public warning that component price hikes were coming, directly comparing the current memory shortage to a 100-year flood event. Wall Street instantly understood what that meant. SanDisk has absolute, undeniable pricing power in this environment. Second, SpaceX announced the details of their massive $75 billion initial public offering. That cash infusion means new infrastructure spending, and new infrastructure spending means massive demand for SanDisk's enterprise solid-state drives. Third, the United States government announced a localized manufacturing partnership between Intel and Apple, which triggered an 11% surge in domestic chip demand sentiment across the sector. And fourth, a United States and Iran diplomatic framework agreement sparked a massive global risk-on rally by reopening the Strait of Hormuz and removing a major geopolitical overhang that had been suppressing energy and risk assets for months. Any one of those catalysts alone would have been meaningful. All 4 arriving in the same 48-hour window was like lighting a fuse on a rocket that was already pointed straight up. But here is what makes the setup for the week of June 22nd so critically important, and this is the part of today's video that I really need you to pay attention to. For the past several weeks, there has been an invisible algorithmic ceiling suppressing SanDisk's price. It is called the Western Digital VWAP optimization overhang. Here is how it works. Western Digital still held approximately 1.04 million shares of SanDisk that it needed to distribute to institutional investors through a private share swap process. When an entity moves that much stock, sophisticated algorithms automatically suppress the price during the distribution window to optimize the exchange rate. essentially keeping the ceiling artificially low to make the swap as favorable as possible for the distributing party. This is a known, mechanical, temporary phenomenon, and it has nothing to do with the company's fundamentals. And here's the critical detail: that private swap process concludes by June 22nd. What happens when that algorithmic ceiling permanently disappears? The artificial suppression mechanism is removed, and pure, unadulterated supply and demand mechanics take over the price discovery process. The airspace above this stock is about to open up in a way it has not been able to since the spin-off. So who are the buyers waiting to step in the moment that ceiling lifts? Let's look at the ownership picture, because there is a very important divergence happening that you need to understand. On the institutional side, the confidence reading is an absolute perfect 10 out of 10. 93.53% of SanDisk's float is held by institutional investors. Vanguard, FMR LLC, BlackRock, and State Street are all aggressively accumulating. These are not momentum tourists. These are the largest, most sophisticated capital allocators on the planet, and they own nearly every single share. At the same time, we are seeing some insider selling at the executive level. The chief legal officer recently sold 600 shares at $1,736 per share, and the executive vice president liquidated 2,000 shares near the $1,755 level. Now, insider selling at all-time highs is completely normal behavior. People have taxes to pay, diversification goals to meet, and stock compensation plans to manage. The relevant question is whether institutional demand is large enough to absorb that selling pressure. And the answer, looking at the ownership concentration, is obviously yes. But it is a yellow flag worth keeping in your peripheral vision. Wall Street's analyst community has been scrambling to catch up with a stock that has completely obliterated their previous price targets. Bank of America raised their target to $2,100. Mizuho went to $2,200. Cantor Fitzgerald upgraded all the way to $2,900. And Susquehanna placed a street-high target at $3,250 per share. Now, the trailing price-to-earnings ratio of roughly 70 times looks expensive in isolation, and if you are using a rearview mirror to evaluate this stock, you will miss the entire story. What matters is the forward view. Based on fourth-quarter earnings per share expectations of between $30 and $33, the forward price-to-earnings ratio compresses to a remarkably reasonable 30 times. That is the multiple of a healthy, high-quality growth business, not a bubble. It looks expensive looking backward. It looks cheap looking forward. The technical picture reinforces every piece of the fundamental thesis. SanDisk is trading 52% above its 50-day moving average and a staggering 185% above its 200-day moving average. The MACD is reading 68.94 and the ADX is above 40, which signals an extraordinarily strong and sustained trend in progress. But the most important technical level on the entire board is the $2,000 strike price. On June 18th alone, nearly 240,000 options contracts traded, bringing total open interest to over 878,000. That concentration of open interest has created what traders call a gamma floor, a structural support level that market makers are heavily incentivized to defend because of their options exposure. The $2,000 level is not just psychological support. It is mechanical support built into the architecture of the options market itself. It is a very bouncy trampoline. Now, before we get to the tactical blueprint, I want to address the short squeeze narrative directly because I have seen a lot of retail conversation around this topic, and I think it needs to be corrected. Yes, there are 9.2 million shares shorted, representing approximately 6.3% of the float. But the days to cover ratio is only 1.08, and the borrow fee is an ultra-low 0.30%. What does that mean in plain English? Shares are incredibly easy and cheap to borrow. Short sellers are paying almost nothing to maintain their positions. They are not panicking. They are not getting squeezed. They are making deliberate, calculated bets that the artificial intelligence supercycle is an overextended narrative and that NAND pricing will eventually face a mean reversion event. I am not saying they are right. The evidence strongly suggests they are wrong. But I am saying, do not build a trade thesis around a short squeeze that the data simply does not support. Here is your tactical blueprint for the week of June 22nd through the 26th. Overall, directional bias remains long. Your primary accumulation zone, the range where you want to be building or adding to a long position on any dip, is between $2,050 and $2,150. If volatility increases and the stock pulls back more aggressively, your heavy structural support rests at the gamma floor between $1,999 and $2,000 even. For options traders, consider long call spreads targeting the 2,300 to 2,500 range, or selling put credit spreads below the $2,000 level to harvest premium while market makers defend that floor. Your take-profit zone begins at the all-time high of $2,191 and tracks up toward the $2,300, $2,900, and ultimately the $3,250 analyst targets over the coming weeks. And I need you to hear this clearly. Your absolute non-negotiable stop loss is a daily close below $1,930. If the stock breaks below the low we perfectly called on June 17th, the structural trend has been invalidated, and you need to exit the position without debate, without rationalization, and without hesitation. A great trade setup with a broken stop is just a loss in slow motion. Here is the bottom line on SanDisk. This company has completed one of the most remarkable business model transformations in the history of the semiconductor industry. They entered 2025 as a dismissed commodity hardware company. They are exiting 2026 as an indispensable artificial intelligence infrastructure utility with $42 billion in guaranteed revenue, 78% gross margins, an unbreakable supply chain foundation, and institutional ownership north of 93%. The artificial intelligence gold rush is not slowing down, it is accelerating. And right now, SanDisk is selling every single shovel that every single miner needs to dig. Could the broader market experience an unexpected macro shock that temporarily disrupts this thesis? Of course it could. Could hyperscaler capital expenditure plans get revised downward in a sudden about-face that surprises everyone? It is theoretically possible. But the probability of that happening while $42 billion in locked-in contracts sit on the books and 4 simultaneous catalysts just ignited a breakout to all-time highs? That is a scenario you should not be betting your entire framework on. The removal of the Western digital algorithmic overhang on June 22nd is the final mechanical unlock that could open the door to the price targets Wall Street's most aggressive analysts are projecting. The setup is clean, the thesis is validated, the catalyst is dated and confirmed, and we told you exactly where the low was going to be before it happened. Before I wrap up, I have to be responsible and transparent with you, because that is what Smart Stock SAM is built on. Nothing in this video constitutes financial advice, investment recommendations, or a solicitation to buy or sell any security. Everything discussed here is for educational and informational purposes only. All investing involves risk, including the risk of losing your entire principal. Past performance, including any accurate price forecast discussed in this video, is never a guarantee of future results. Always conduct your own due diligence. Consult a licensed financial professional before making any investment decisions, and never invest money you cannot afford to lose. The market can remain irrational longer than any of us can remain solvent, and even the best setups sometimes fail. Trade with discipline, manage your risk, and protect your capital above everything else. Now, here is what I want from you, because this community is what makes this channel worth building. Drop your answer in the comments right now. If the Western Digital Algorithmic Ceiling lifts on June 22nd and SanDisk breaks cleanly above $2,200 on massive volume, do you think the institutional momentum alone is powerful enough to carry this to $3,000 before end of year, or will profit-taking and NAND spot price uncertainty create a wall that stalls the rally? I genuinely want to know what you think, and the best comments always spark the best follow-up videos. If this breakdown gave you real value today, hit that like button. It costs you absolutely nothing, and it tells the algorithm that precision forecasting content like this deserves to reach more serious investors. If you are not subscribed yet, what are you waiting for? Hit subscribe and ring the notification bell so you never miss a call like that 1938 bottom we nailed last week. And if this channel has genuinely added value to your portfolio journey, you can support the work directly by sending a super thanks right here on YouTube. Every single one gets read, and I appreciate each one more than you know. Finally, and this one is important, I have launched an exclusive Smart Stock Sam membership community right here on YouTube. Members get early access to trade setups, priority replies to their queries, deeper dives on the mechanics behind these calls, and a community of like-minded investors who are doing the same serious work. If you want to level up your investing and your trading in a real, structured, and accountable way, the link to join is right below this video. I will see you in the next one.